Hey everyone, and welcome. Today we are jumping into one of the biggest financial steps you'll ever take, buying your first home. It's a massive decision, and honestly, getting a grip on how mortgages work is the absolute key to doing it right. So if you're even thinking about buying your first place, you know the feeling. It's super exciting, but yeah, it can also feel a little daunting. This isn't just about buying some bricks and mortar, you're making a huge investment in your future.
You know, it helps to think of this home mortgage thing as a journey. There are different roads you can take, and yeah, there are a few potholes to watch out for. So today, we're going to give you the map so you can navigate the whole process like a pro.
Okay, let's start right at the beginning. Before you even start dreaming on those real estate apps, the real first step is taking a hard look at your own finances. Lenders have a very specific playbook they use to figure out if you're ready, and you've got to understand it.
So, first things first, what even is a mortgage? Well, stripping it all down, it's a loan. But here's the kicker. The house itself is the guarantee. If you don't pay, the lender can take the house. It's really that straightforward, and that's serious.
And this is the million-dollar question, right? Sometimes literally. This isn't about the price tag on your dream home. It's about what a bank or a lender is confident you can responsibly pay back, month after month, year after year. To figure that out, lenders have one main tool in their belt, your debt-to-income ratio, or DTI. Seriously, this number is everything to them. It's just your total monthly debt payments divided by your gross monthly income, and gross just means your income before any taxes are taken out.
So here's the first number they're going to look at. Lenders generally want your total housing costs. We're talking the mortgage payment itself, plus property taxes and homeowner's insurance, to be no more than 28% of your gross monthly income. This is what they call the front-end ratio. But wait, that's only half the picture. Next up is your back-end ratio. This includes that new house payment, plus all your other regular debts. You know, car payments, student loans, minimum credit card payments. All of that, altogether, should ideally be no more than 36% of your gross income. Those two numbers, 28 and 36, are pretty much the gatekeepers to getting qualified. So knowing your DTI is huge, but it's just step one. Step two is getting inside the lender's head and understanding the bigger picture they use to size you up. They call it the 4 C's of credit: capacity, capital, collateral, and credit. I know, it sounds a little formal, right? But these 4 things are the absolute pillars of any loan application. Let's break down what each one really means. First up, capacity. This is all about your ability to actually pay the loan back. Your DTI ratio is a big part of it for sure, but it's also about your job history and how stable your income is. Lenders want to see a reliable, consistent track record. Next is capital. This is basically the cash you're bringing to the table. We're talking about your savings for the down payment and all those closing costs, but also other assets like investments. It proves to the lender that you're prepared for the upfront costs, and you've got a little bit of a cushion. Then there's collateral. For a mortgage, this one's super easy. The collateral is the house you're buying. It just means that if, worst case scenario, you stop paying the loan, the lender has a right to that property to get their money back.
And finally, credit. Think of this as your financial report card. Lenders are going to pull your credit report and score to see exactly how you've managed debt before. A solid history of paying your bills on time is absolutely critical if you want to lock in a good interest rate.
Okay, so you've got a handle on how lenders are going to look at you. Now it's time to look at the different kinds of loans out there. And the very first big choice you'll have to make is between a fixed rate or an adjustable rate mortgage. On one side, you've got the classic fixed rate mortgage. Your interest rate gets locked in and it stays the same for the entire life of the loan, whether that's 15 or 30 years. It's the definition of stable and predictable. On the other side, you've got the adjustable rate mortgage, or an ARM. These usually start with a lower, tempting teaser rate, but that rate will change over time. Your payment could go up or it could go down. It's a classic trade-off, a lower cost up front in exchange for taking on more risk down the road.
So you might be wondering, if the rate on an ARM changes, what actually causes it to change? Well, it's tied to something called a financial index. Think of it like a major benchmark interest rate that just floats up and down with the overall economy. The lender doesn't control this part. It's all about the market.
The second piece of the ARM puzzle is the margin. This is a fixed number of percentage points that the lender adds on top of the index. This part is the lender's profit, and unlike the index, the margin stays exactly the same for the entire life of the loan.
So you put it all together, and the formula is actually pretty simple. The fluctuating index rate plus the lender's fixed margin equals the interest rate you're actually paying.
If you can remember that simple equation, you'll always understand how an ARM works.
Now, knowing the path is one thing, but you also got to know where the traps are. The world of mortgages has some common pitfalls, and it is so important to know what to watch out for so you don't fall into one.
This quote really nails it. Some loans are built on what's called lax underwriting, which is a fancy way of saying the lender didn't really do their homework to make sure the borrower could afford the payments. You have to be able to recognize the warning signs of these riskier loans. And this chart shows one of the biggest dangers of an ARM, something called payment shock. Just look at these numbers. In year 1, the payment is a pretty manageable $477. But when that rate adjusts in year 2, the payment jumps by almost $190 a month. That's a huge hit, and you have to be ready for it.
Some other traps to watch for are so-called no-doc loans, where a lender doesn't properly verify your income. That might sound easy, but it can set you up to borrow way more than you can handle. Also, with an ARM, you have to understand the rate caps. These are the safety nets that limit how high your rate can go. And please, don't make the most common mistake of all, focusing only on that low initial payment. It's the future payments that matter.
So, there you have it. You've got the map, you know about affordability, how lenders think, the different loan types, and the biggest dangers to avoid. Your journey starts with getting educated. A fantastic next step is to look into a certified first-time homebuyer course. With all this knowledge as your foundation, you're ready to start moving forward, one smart, informed step at a time.